Okay, hi everyone. My name is Marko Čula. I'm professor from Faculty of Economics Split. Today I'll be talking something about your financial model. I see your ideas yesterday. Your ideas is so nice, but I think so that you have a big problem with your finance. I don't find the money into your idea. Okay, today we will start first with a financial model, with a basic financial statement that we will include into your business plan. We will talk about net income statements, balance sheet, cash flow statements, etc. First, I will start with your financial model like this. Imagine your business is a tree, a fruit-bearing tree, like an apple tree. Okay, this is your business. Okay, you see everything. Yeah. The first financial statement we call the income statement or profit and loss statement. The income statement measures the fruits of your business effort. It's apples. Okay, it's income statement. It's easy, yeah? It's not easy. Like a tree, your business produces an annual yield. Okay, and that gets reset every year. Okay, what is the income statement or profit and loss statement? The income statement starts at zero at the beginning of every year. When you start your business, you don't have income statements. Your income statement is zero. You don't have revenues, you have only costs or your expenses. And measures the annual yield. Okay. This is a good example of one income statement. This is the part of income statements. First, this is example for olive tree winery. You see here the years ended. And you can see here the part of income statement. First part of income statement is your revenues. As I see yesterday, you don't have problem with revenues or how to collect your money. But I think so that you will have the big problems with your expenses or costs. The part of income statements is revenues, expenses or cost, and net income or net loss. This is the part of income statements. Please now give me my materials. You will give a lot of my materials about financial projection. First, the first part of profit and loss statement or net income statement is revenues. You don't have a problem with projection of revenues. Revenues represent a positive element of profit and loss statement, which is a result of sale of goods and services. You will do in your business plan monthly and annual revenue projections. You don't have a problem with this. Yeah? The second part of P&L statement is the cost or expenses. Expense represent a negative element of P&L statement, which is a result of sale of goods and services or business in general. There are three parts or expenses. First, this is the cost of goods sold. Yeah? The second one is the selling and administrative costs. Yeah? And the third one is interest expense cost. Okay. The first one, cost of goods sold, represent direct costs which are caused by sale transaction. It's caused by sale transaction. For example, direct materials, worker wage, and amortization. You know what is amortization? Think about, for example, of your amortization when you start your business. You buy, for example, your office, you buy your PC, you buy your land when you start your business. Everything is your fixed assets. When you have a fixed asset, you have at cost of amortization. Think about amortization. For example, if you start your business this year and you expect the first revenue, for example, if you have, for example, vinyl, if you, for example, for 3 years, you expect the first revenue of your business, think about your amortization. For example, if you start your business in this year and you expect every year, for example, 100 euro approximately revenue, yeah? Think about amortization on this level. For example, you buy some machine and you have 25 kuna or euro, sorry, every year of cost of amortization. This is the linear model of your cost of amortization. It means every year 25 kuna of cost of amortization. It's a linear model, yeah? Is the time, is the money. This is your revenue, and this is your cost of amortization. It means ceteris paribus. It means net profit is 75. If you decide, for example, think about your amortization, cost of your amortization, you can do this value of your amortization. Degressive method or progressive method. If you start your business and you expect, for example, for 3 years, a lot of revenues, yeah? You decide this model of amortization, progressive model. It means in first year, only 10 kuna, for example. In first year, 10 kuna. Your profit is now 90 kuna. Yeah? If you expect in first year a lot of revenues, then you choose degressive model of amortization. It means in first year you use 40 kuna, for example, of your amortization. Then you have a profit net income is 60 kuna. It means difference method of amortization, difference value of net income. Think about your amortization. It's main cost of your business, for me. Okay. This is a cost of goods sold. The second one is selling and administrative costs. These costs are not directly caused by each sale transaction, but they are rather caused by business activity in general. It means marketing costs, traveling costs, etc. And last one is interest expense cost. It means if you loan credit for the bank to finance your job, you have interest. Interest is a main cost, yeah? Okay, please. Please continue. Okay. This is the income statement, the first statement. At the end of each year, your net income is added to return earnings on the balance sheet. Balance sheet is the second one, we have lunch now. Yeah? At the end of each year, net earnings is added to return earnings on the balance sheet. The second one, the second financial statement that is very important for you, for your business, and how to start your business. Okay, everything is clear for now, yeah? The balance sheet is a picture in time. It measures the cumulative result of your business efforts. It sustains in your business over the long haul. Okay, a tree cannot bear fruit without the support of a strong trunk. Okay, a business cannot produce annual net income, your profit, without a solid balance sheet. Okay, the balance sheet measures what you own and what you owe. what you own is called your assets, and what you owe is called your liabilities. Okay. The equity is the difference between assets and your liabilities. Also, equity approximates the net value of your business. Okay. If you slice open the trunk of the tree, you can read the story of each year in its life. For example, you will find lean years, this red color, with little or no net income, and strong year with plentiful net income here. Okay, understand? Those rings are like the equity section of the balance sheet. It means accumulated return earnings is equity, is your equity. And the equity is the difference between your assets and your liabilities. Okay, here's some example of a balance sheet of olive tree winery. We have two parts of the balance sheet. Here is your assets, and here is your liabilities and the equities. You have, for example, current assets and fixed assets. For example, fixed assets is your office, your land, your machine, your car, and special, etc. Your current assets is, for example, here, Olive Tree Winery, is your cash, receivables, inventories, etc. It means, first is your assets. We have current assets in a short time that we receive the money and collect the cash, and fixed assets. On the other side, we have liabilities and equities. The main question for assets, what we own. And the main questions for liabilities and equities, what you owe. And how we collect the money for investing in our business or to buy our fixed assets. The other part of balance sheet is liabilities and equity. If you invest your money, it's your equity. When you start your business, okay, questions at the end of presentation, I think. If you invest, I don't know, your cash into your money, it's on one side is the current assets, on the other side is your equity when you start your business. For example, if you don't have money, you loan the credit, it's your liabilities. This part is your liabilities and your equity. Okay, this is my correction. Is easy or? It's not easy, huh? Okay, the second one, balance sheet, important financial statement. There are two parts of your balance sheet. I will repeat, assets and sources of financing. On the first side, assets is we different. Have current assets and fixed assets. And source of your financing is your equity or your capital and borrowing some money. It's your liabilities. What we have in this part of balance sheet elements? We have fixed assets and current assets. What is the element of fixed assets? It's intangibles, land, buildings, machines. Also, your application. Also, your application is software. And software is also the part of fixed assets. It's non-material assets. It's not material, it's non-material assets, like a patent. Okay, think about it. Then, current assets is your cash, receivables, inventories, etc. Also repeat, your equity or capital, your liability. It means what we own. Okay, the capital, if you invest in your business, your cash is your capital. If you loan the credit, is your liability. Okay, no problems? No. Okay, možemo. Balance sheet, PL statements, or net income statement is the second one. The third one is cash flow statements. If you don't have cash, there are no business. Yeah. Without water, no tree can survive for long. You agree, yeah? No business can survive without cash, without my paper with dollar yesterday. Yeah. The cash flow statement shows where the water went in your business. The main questions are here. How much cash was consumed by the income statement? It means the income statement is your fruits, it's your apples, it's your business. Here's your business, here's your fruits, here's your apples. Your apples is part of your income statement. Think about your revenues, think about your costs. Think about your cost of amortization. Amortization is connected to balance sheet. Two statements, balance sheet and PL statement. Okay. The second question is how much cash was consumed in growing the balance sheet? This is the balance sheet. What is the water? Water is cash flow statement. The water is your cash. The cash flow statement connects the income statement to the balance sheet. I will repeat. The cash flow statement connects the income statement to balance sheet. It's your water. It's your water of your business. Cash is the water of your business. Yeah. Here's a, for example, statement of cash flows for Olive Tree Winery. Okay, cash flow statement is divided in three parts. The first part is operating cash flow. Operating cash flow. The second one is investing cash flow. And the third one is financing cash flow. Operating cash flow plus investing cash flow plus financing cash flow is a statement of cash flow. Okay. You need the information, the money, cash from the beginning of the year plus the cash flow, net cash flow, is cash balance of the end of the year. Okay. Please, Marina. Cash flow statement. We have a three-part of cash flow statement. Operating cash flow, inflows or outflows, investing cash inflows or outflows, and financing cash inflows or outflows. You don't take care about cash flow statements when you start your business. When you start your business, you have outflows. Okay, you need to collect your money. Yeah. Look, annual cash flow statements. Here is the first part of annual cash flow statements is net cash flow from your operation, from your year. Yeah? The second part of cash flow is net cash flow from investing. And the third part is net cash flow from financing. What do you think? When you start your business, what is the net cash flow for financing in the first year? Think about. Why negative? If you, for example, use the credit from the bank, loan the credit from the bank, what's about with your net cash flow? Is negative or positive? We talk only about net cash flow from financing. Is positive or negative? If you loan the credit, answers positive or negative? Positive. Why positive? On the one side, you know, for T-Conto, you see it for our account. When you receive your money, on the one side, you have liabilities. You loan the credit. This is the money. And you receive the money on your cash. Yeah? It's mean, in this part, the part of net cash flow from financing, in the first year, when you, for example, loan the credit, this part of net cash flow are positive. You receive the money. Okay, What's about with when you start your business in the first year? What's happened with your net cash flow from investing? It's positive or negative in the first year? Negative. Why negative? Why negative? When you start your business, it's your cash, yeah? Is your money, I don't know, $2. Yeah, when you start your business, yeah. You buy some liability, you buy some fixed assets. For example, you buy land. You buy a land, for example. You need these fixed assets for your business. If you buy the land, you put this $1 for your land. You have a negative part of net cash flow from investing. Think about it. When you start your business, is the time, is the money. In the first year, net cash flow from investing is a negative. From the first year, net cash flow from financing is a positive. And slow down. Okay. Think about the cash in your cash flow statement. Think about it. You need to think about it. Now, I will repeat. You need to make your financial projections for your business, for your idea. It's not necessary only I have idea. Okay, where's the money? Where's the cash? Where's the dollars? Kunas? Euros? Think about these 3 financial statements. Think about your balance sheet. Think about your PL statements. And think about your cash flow statements. When you start your financial projections, think about your balance sheet. Think about your assets. And think about your sources of financing. Think about your assets, fixed assets, and current assets. How we own our business, yeah? Okay. Also, how much money, the part of money that we invest in our business. It's our own money, or we loan some credit. Okay. When you make projection of revenues is a part of PL statements. Think about projection of revenues on monthly, weekly, annually. Think about it. I don't think so that we will have big problems with collect the revenues. But you need to think about your expenses. Think about your cost of goods sold. Think about selling and administrative costs. And think about your interest expense costs. If you loan the credit, you have interest expense costs. If you buy fixed assets, you have a cost of amortization. Don't forget it, yeah? The third one. Okay, hey, just a second. P&L statement. How we make good profit and loss statements. When we start with our profit and loss statement, we start with our revenues. We start about our revenues. And we make projections for the futures. Weekly, monthly, annually. Okay. Think about your costs. These costs. Costs of goods sold. Difference between revenues and costs, is gross profit. Difference between gross profit and selling, some cost about your selling activity, advertising activity, etc., is your operating profit. If you loan the credit, you have the interest. Difference between operating profit and interest cost is profit before tax. At the end, don't forget our country. Don't forget tax. Difference between profit before tax and income tax is your net profit. You find net profit where? you find net profit in your balance sheet. It's okay. The last one, cash flow statements. Cash flow statement represent measure of business success defined by cash inflows or outflows. Cash flow statement is divided on three parts: operating cash flow, investing cash flow, and financing cash flow. Think about when you start your business, which part of your cash flow statement is positive or negative. You can earn the big profit, net income. Okay, you can grow the profit. But if you don't have a cash, what's the future of your business, yeah? Think about it. Cash flow statements is the water of your business. Okay, please presentation. Operating cash flow keeps the business running. Don't forget this information, yeah? At the end of this presentation, before the lunch, income statements, balance sheet, and the cash flow statements. Success in business requires a focus on all three financial statements. If you forget one financial statement, there is no your future in your business. If you forget cash flow statements, you forget the money. If you forget income statements, you forget your profit. If you forget your balance sheet, you don't think about your fixed assets. You don't think about your land and your future in your business. Think about this information. Now we have a lunch. And after lunch, we have mentors, yeah? And individual problems and questions we will make after lunch. It's okay. Thank you very much.
Basically, at 2:30, sit down.